Let's begin with rental income. Any payments received for the use or occupation of real estate is rental income, whether the rental is residential or commercial. Each rental property is individually identified, and so the payments similarly have to be divided among the properties. In addition to traditional rent, there are other things that may be considered rent, such as advance rent. If you receive rent for the next tax year, you include it in the year received. For instance, imagine that you rent out an apartment and the tenant pays you the rent for January and February in advance on December 27th. Even though the rent hasn't been earned, it is still considered taxable income in the current year. Another form of rental income is for property or services that you received instead of rent. For instance, a renter says, "I'll repaint the kitchen if you'll give me a $100 credit on my rent for that month." The $100 should be included as rental income. However, you can also deduct the $100 as a maintenance expense. Security deposits, on the other hand, are not included as rental income until it is earned. So if the taxpayer keeps a security deposit and intends to repay it to the tenant, then you don't include it as rent. If it is used for the last month's rent, then you do include it in the year in which the rent is earned. If you receive a payment for canceling a lease, it is rental income when you receive it. For example, if the taxpayer held a 1 or a 2-year lease and the tenant had to move prematurely and paid you a bonus to cancel the lease rather than pay it out, you should include the income in the year it was received. By the way, a home that is also used as a rental property fewer than 15 days during the tax year does not need to be included as income. For instance, my hometown sponsored the Winter Olympics in 2002. Many people rented a portion of their homes out to guests during the 2 weeks the Olympics were held. Since the rental was fewer than 15 days, it was not required to be reported as rental income. To arrive at the rental or royalty net income or loss, you need to subtract expenses, which are listed in Part 1, and for the most part are easy to understand. A line-by-line list of the different types of expenses and what to place on those lines is provided in your workbook. There are just a few points worth noting. In our discussion regarding capital assets, we discussed treatment of capital improvements. This same discussion applies to rentals as well. If the taxpayer makes an expenditure that increases the value of a property or prolongs the life of an asset, it is a capital improvement rather than an expense. For example, if the owner of a rental repairs a crack in the sidewalk, it's considered an expense and is deductible on Schedule E. However, if she adds a sidewalk, it's a capital improvement and is not expensed on Schedule E. Instead, it increases the cost basis of the home and is amortized over a certain number of years. Other common examples of capital improvements are provided in a table found in your book. What happens if we have a rental property that's vacant? Any ordinary and necessary expenses during a vacancy can be deducted against that property. However, you cannot deduct any loss of rental income for the period the property is vacant. Given that the taxpayer only counts the rental income when she gets it, the fact that she didn't get rental income is not a deductible expense. Most landlords check on their rentals often. Travel expenses are deductible. In the majority of cases, this is in the form of mileage with the landlord using a personal vehicle. As we'll explain in Module 2, the taxpayer can deduct mileage at a standard mileage rate, assuming, of course, that they keep tabs on how many miles they drive. Additionally, if they have multiple rentals, the mileage deduction will need to be divided between the various property. This division of expenses between properties applies to other areas as well. For instance, the tenant may have one insurance premium for all properties. If all the different properties are similar in size and value, then the insurance expense can be divided equally. However, if one rental has a substantially higher value than the others, the insurance should be divided based on property value or some other logical basis. Calculating depreciation expense for rentals is relatively easy. Although we're going to tackle the complex nature of depreciation in Module 3, which includes providing a simple table to assist you, it's sufficient to say that depreciation for rental units is spread equally over 27.5 years. Regarding rentals, it's also important to note that land is not depreciable. So using either an appraisal or property tax records, you'll want to subtract the value of the land from the basis of the property before calculating depreciation. We have an entire chapter dedicated to depreciation in Module 3, so you'll want to refer to that section before completing Schedule E. When using homes and other dwelling units for both rental and personal use, you must divide the expenses. A good example of this is when the taxpayer lives upstairs and rents out the basement to college students. In this case, you'll use square footage or number of rooms to divide the household expenses such as utilities, insurance, interest, depreciation, and maintenance costs that benefit the tenants. A division of expenses is also necessary in the year a main home is converted to a rental. If the taxpayer moves out of his home in October and begins renting out his previous residence in November, only the expenses incurred from November forward are deductible on Schedule E. By the way, daycare is not considered a rental business, so we'll discuss how to report income and expenses for that business in Module 3 when you learn about sole proprietorships. When reporting a loss on Schedule E, there are two terms you must understand in order to finish the form. They are passive activity and at-risk rules. Often a rental's first year will show a loss because there are extra expenses up front and a learning curve that can result in higher costs than the rentals earned. This is particularly true when you add in depreciation. Generally speaking, you may not deduct losses from passive activities. Passive activities are those where the taxpayer does not materially participate in the activity. Although there are several factors in arriving at the level of participation, the most determining is whether or not the taxpayer spends 500 hours or more in the activity during the year. However, real estate is always considered a passive activity regardless of the level of material participation unless the taxpayer is a real estate agent. Assuming the taxpayer is not a real estate agent, there is a special loss allowance for rental real estate rule that allows for rental loss recognition up to $25,000 a year. The second consideration when reporting a loss for passive activity is the at-risk rule. This applies to activities conducted as a trade or business in the production of income. Losses are allowed only to the extent of the taxpayer's financial investment in or financial risk from the activity. What is the at-risk rule? Well, this rule places a limit on the amount that can be deductible as a loss from activities often described as tax shelters. Generally, any loss from an activity subject to the at-risk rule is allowed only to the extent of the total amount at risk in the activity at the end of the tax year. Since most landlords stand to lose their entire investment in the home, then their loss is limited to their equity in the home or $25,000, whichever is less. Form 6198 will lead you through the calculation to determine if there is any at-risk limitation. Remember that these two rules only apply to rental activities showing a loss. Gains from rental activities are not restricted. To get around these limitations, I've had clients become real estate professionals. My simplified definition of a real estate professional is a person that spent 750 hours or more a year developing, constructing, acquiring, or operating real estate as a business. A more detailed description exists in your book. When your client sells rental property, you'll want to report the sale in Part 3 of Form 4797, since most rental property is considered Section 1250 property. You'll learn more about Form 4797 in the next session. And one more thing. In the year the sale occurs, depreciation should be calculated and deducted on Schedule E for the period prior to the sale.